Hey, greetings clients. I wanted to do this video now that the day has quieted and some of my intermarket analysis end of day ratios have settled in. I want to basically send out this video after a very large drop that we anticipated strongly. So that's the good news as far as positioning for it and such. But it is bad news that I don't think we're going to bounce very much. So I wanted to show where I come up with that. And first and foremost, we know that there's been steady and professional selling since Monday morning at 10 a.m. Just in and of itself, the cumulative volume index that I was luckily able to get posted with Zeke this weekend so that we could follow along. And when I have my room closed during the cash session, you can still follow along to see that it was steady. And I mentioned slow and steady wins the race. So even though price action in the indices was stable, underneath the selling was quite apparent. And this is literally a perfect trend line tag Monday at 10 o'clock, and every hour bar, with the exception of one itty bitty one here, has been red, including the final hour bar today. So we've had 3 days of steady professional selling, and that's a concern because we're not on any support intraday. We went, actually, this was my price target for this accumulated volume today, right? You might have noticed I closed some shorts thinking, we'll stabilize and bounce. Nope, we didn't. We went and sliced right through it. So that was a great timing signal short for a chase. And then yesterday this morning in the trading room I mentioned, no, this is turning into swing time frame. And this was all predicated on my analysis on this daily as well as weekly time frame, that this was obviously from October 2018, a tag to the January divergence into the February-March 2020 crash, 35%. We tagged again and caught the pullback in June. We tagged and caught again the pullback in September. And I mentioned this looked like a low risk entry short. I'm wrong if it got above. Well, we didn't, and here we are. And this morning in my trading room, I also mentioned as a warning that we would likely have a significant continuation, and we were at negative 0.18 when I said we could have a negative 1.18. We ended up far surpassing that. So clearly we are in trouble, and I don't think the market knows how much trouble. So Craig made a point to my comment that the market, very few know how dangerous and broken this market is right now. We do have COVID cases surging, and they'll be increasing as college students come home and holiday gatherings, etc. And the rural hospitals aren't prepared for this. And we have many, again, still resisting it. So without a vaccine, and none is on the horizon, as I mentioned, even the antibody trade that I highly recommend is out of Switzerland, and it still isn't going to be here for another year. The fact that we have no fiscal stimulus agreed to, and they're on break, and a very contentious election likely coming up, we have a problem, and this is proving as such. I mentioned this is very bearish on a day trigger, but also even on intraday. This, and I mentioned also in the trading room, is not bullish for a bounce even until it can get above this oscillator. So oversold can stay oversold for a month, and it can turn into February, March, and I'm not kidding. So here's where I wanted to do a quick video and show you why I am concerned, even if we get a bounce, okay, that we're under pressure. So stock bond volatility analysis says we're not done. And this is nuanced. I know I have my own special approach here that's not easily emulated, But when I say, trust me, when I say this trigger above zero is bearish, this is intonating higher, I warned about this, it's bearish. We're not even in overbought territory yet. That's scary bearish. So this is on a daily time frame. We tagged, as I expected, right here. Okay, we came back a little bit. We just cut right through the 65. We are through this trend line. I know volatility is up 20-something% today, and it was very exciting to be prepared for it, right? Here's VIX coiling. Here's NASDAQ volatility coiling. I mentioned it didn't have any more room. It had to go one way or the other. And obviously my position was we were going to go lower. And this was not uncertain. So that was my whole thesis leading into this. Volatility is not uncertain. So going back to this indicator, I expect we're going to have more, and it's going to reach the 200-day moving average. So we're not there yet. Other reasons why I see a very bearish continuation play, I mentioned right here, if we got above, this would be bullish, the small caps, right? This inverse head and shoulder that many have seen on the spiders and the, Russell, etc., etc. Nope. We broke it yesterday. That was bearish. And then we just collapsed through the 50, the 100, trend line, etc. So could we have a little bounce? Sure. But you know how I feel about this. I warned that this was crossing over and that the MACD histogram was crossing below zero. That's very bearish. So my put call volatility ratio, that again is very nuanced. Trust me when I say we haven't even gotten up to 90 yet. 0.90 is when we have volatility really enter the market. So they're still not buying puts to the level that this would actually indicate fear. I've warned about this and it obviously triggered. This was backwardation. Didn't show a lot in the last 2 days, but we saw the selling under the surface. Boom, backwardation. A little bit yesterday. You've seen these charts. I show them in the trading room every day, but my point is we've got confirmation. We also closed on the lows. This is a McClellan summation rollover. This is my gold, precious metals basically. I've mentioned gold was not going to be a hedge. We've got Bollinger Band tags in play. I'm still short GDX. Gold really and silver really haven't even started to sell off. This is my price target. I've mentioned advanced decline issues. I think this comes down and continues down. 3,200, obviously 3,270 was not hard. We probably have a little bounce. There's the 50-week. This looks still like a solid tag is coming below 3,200. I'm honestly worried about this breaking. This has been in place since 2009. Very strong. Then we got a little bit continuation here, this head and shoulder continuation from 2016 after the oil industry recession. We moved higher. We bounced solidly right here on trend line. I think the next time we break, I think we're going to head down here in advanced decline. I don't think folks are expecting that. You know my momentum and anti-momentum ratio chart that I use, which is basically just equal weighted RSP to SPY. Double top, we just tagged right here. So value is not moving, and I'm going to explain why I don't think we're going to have much of a chance for that to get really up off the ground. Not just COVID, but from the charts. But what I think we are going to get up off the ground, and I don't have my my dollar ratio charts uploaded yet. So this is yen. Yen, as I have warned, looks like we're about ready to launch into escape velocity, which is very bearish, the USD JPY. This is just an ETF to show because it's easier to chart. This is very bullish the yen, bullish the dollar. That's a problem. Safety trade. Folks go to cash and they go quickly. I mentioned before that this transport ratio Fabulous buy here, 2004 lows. We got extended. Think UPS, FedEx, gorgeous charts, gorgeous plays. But now it came back, and that was what I expected. This would calm down, and it needs to basically consolidate before moving higher. It's rounded, it's breaking. IYT has been absolutely the strength in the market, stronger than the NASDAQ. It's coming back in. So leaders are starting to break. I warned that this was going to be tough. This is small caps, right? Above is bullish. Well, it just cleared all the gaps lower below the 50-day. So watching this to see how we do on this trend line, but that's a choppy mess. That's also in trouble, which I will elaborate with a little bit more, but we had a cliff save. We were about ready to roll over, and then we went higher, and I said it needs the energy to basically now really put the fear in. And here's where I think we're going to have some deflation impulse now trigger. This is tip TLT ratio. It's in a channel of sorts, but it also looks like a bear flag is forming. I'm expecting that to turn, and if we do break this, we have got a big problem in potential continuation of lower rates to the tune of maybe even negative. I'm actually really worried about this, strangely, this chart. And then it's backed up with this XLF. XLF has not crossed, the 50 has not crossed below the 200 since 2008. This is, I should have shown you the rest of this. Anyway, you know what happened in October to 2009, right? That was the waterfall cascade. Well, this is where we are right here. So I had mentioned earlier at bank earnings that we had a gap here and we had a gap here. Where were we going to go? Well, clearly we're on our way to the $22 one. That's not looking good, and neither are yields right now. This is XME, which is also a commodity play, if you will, a bet on reflation, inflation, which I contend is a fabulous play long when we have a yield spike. And I'm really good at telling when we're going to have a yield spike. And we have right now a pullback after a yield spike. But this is a little bit important because this was concrete. And I mentioned if we get above, right, like we did here, and it got repelled, we got above, it looked like it was basing. I said if we lose this level, we go lower, that's very deflationary. So we haven't broken relative to SPY. I think we're getting into some dangerous territory as well here. That would go along a little bit with my gold and silver short, crude short. I have my mantra on energy complex has been repeatedly 4 months, stay away from the cookie jar. There's nothing to buy there. There's just nothing to buy there. It's not good for you. It's just, they're empty calories. The only thing that is very strong still is retail, and I mean the big box plays mostly. So I'm watching this to see if we're going to, form some dangerous pattern coming up. But for right now, retail is still relatively strong. I don't expect that to stay strong, obviously, but for right now, that's hanging out. DAX, what did I show you just Monday? That this was about ready to roll over. I showed you this particular crossover and the zero mark. We had already lost breadth, and that's what happened today. 5% plunge, cleared through all of the weekly moving averages. And what did I give for price target? 11,000, 10,750 area. It's on its way. You know Asia and China are going to look very weak tonight. And here was the other warning I gave. We had a double top at this wedge breakout on the global ETF, the MSCI. This is what happened. I said low risk entry, likely we come back. We haven't broken all the moving averages. It's just starting, but this was why I was bearish. Here, here, and here again. We've formed another double top, and we've crossed over. Here's the tip TLT ratio. Above is bullish, reflation, commodities, go long. Below is bearish. We tagged and came right back in. We have what looks like, I think, a retest of lows. This hasn't turned yet, but this is not a good look unless we can get above. Bonds, what are they doing? They're not doing much, and that's actually a big worry. We need some kind of hedge. VIX is outsized right now. Bitcoin was for a few days. Gold, precious metals are not serving at all as a hedge. They look just like the stock market, ready to roll over hard. Energy is, again, about ready to be crushed. Yields are not popping in this deflationary environment. And bonds right now are giving me a mixed signal. They're on trendline support. They should be bouncing. We had a 3.5% down day across all the indices, and bonds were red at one point. That's very risk off. If they can't even hold a hedge, we have some issues. So I'm looking at my indicator, which by the way has been pretty nice smoothing indicator of when to get into and out of bonds. You can see here, little flat line. It needs a little bit more time, but it's indicating a short in bonds, even though we're at a double level of trend line support, and we had a bond bounce on target with my 30-year, if you recall, and it was a great tell. I mentioned here there was 4 levels of resistance on this 30-year yield spike, and we came right back in, right? So I am still looking at yields as a negative. They're heading lower. Bonds, however, didn't get so much energy today. I mean, they're at the 200. Above is bullish, but that was not what I would call a stunning showing. I still think it's a much better play long than short, but it was very, very unimpressed. Let's just put it that way. So, Eurozone, this is on a monthly. I mentioned warning. This is getting a little heavy, and we already broke actually lower on my indicator at the beginning of the year, and obviously it's got a long channel. It moves very slowly, but Eurozone is not helping. We saw what's happening with Germany. We can tell that volatility here from 2007 to 2009 took a little while. Well, we are pushing back above, and I'm looking at this right now going, okay, we got some sectors that have been extremely strong, semis, right? The IPO space, fintech, social media, fintech, excuse me, cyber, but you can also tell they're coming down. So we've got weakness in the beloved or the love children, and my biggest fear is that we actually have maybe a week, maybe a week. But this is moving up very quickly to the 200-day. And I just want you to know about that in case you are a futures trader or you're wondering if we had such a big down day that we should have such a big up day tomorrow. This is telling me not so much guaranteed, but that the swing short thesis is, I would say, just starting this week. All right, I hope it helps.